crazy volatility in the markets, I will explain to you 3 reasons why the markets are crashing and which sector was mostly sold off recently and if there is a buying opportunity. I will walk you through the most common mistakes the new investors do when they start investing into the market and face the market downturn. And finally, I will walk you through big tech companies from the technical perspective to see if there is a buying opportunity. Spoiler alert, there is. What's going on, investors? Hopefully guys are doing well out there. Welcome back to the video. The reason number 1, the stock market fall after tariffs sparked trade war fears. The president has followed through on a threat to impose 25% tariffs on imports into the US from Canada and Mexico and 20% against goods arriving from China. The reason number 2, the Atlanta's Fed GDP Now model estimate for annualized growth in the current quarter was a stunning minus 2.8% on Monday, down from plus 2.3% last week. Friday's shock reading of minus 1.5% was led by a record high 153 billion trade deficit in January. So basically what's happening is the company knew that the tariffs are coming. So what they did, they just ordered ridiculous amount of inventory in advance so that it will not be tariffed. I would not consider this as a significant catalyst for market to crash. And reason number 3 is seasonality. If you can see here, from the middle of February to the middle of March, the S&P 500 based on the seasonal pattern is falling down, is having some kind of correction. We call it correction. These are 3 main reasons why I believe the markets are down. And now let's see if there is an opportunity there. Firstly, let's check the map of the S&P 500 to see what's the performance of the companies year to date. And here you can see not everything is red across the board. We can see clearly that healthcare is green, industrials are green, consumer defensive is green, financials. So it tells me that the investors are not selling everything across the board. The investors are selling one particular sector, and which sector you can clearly see on the screen is that technology sector. We can see Nvidia is 13% down year to date, Broadcom 17% down, Microsoft 5% down, Apple 6% down, Amazon 5% down, Google 8% down, Tesla whopping 31% down, and the Meta is the only one Magnificent 7 stock which is up year to date. So based on the information we just saw, the investors are selling tech and buying defensive stocks, consumer defensive, healthcare, telecommunication. It means that they are kind of preparing for the recession. It means that they are just in case de-risking, selling the high PE tech stocks and moving into more defensive companies. And I believe this is the buying opportunity for long-term investors. Let me show you why. From the perspective of forward PE, we can see that the tech sector is still quite red. Meanwhile, we can notice that based on the forward PE is the earnings for the analyst estimates of the earnings for the next year for the companies. For Google, this is 17.15. This is dirt cheap for the company like Google. In the previous videos, I explained what's the reason Google has such a low multiple. There is a worry in Wall Street that Google is losing market share in a search and some uncertainty around Google. But 17 PE for Google is just ridiculous. For Nvidia, PE of 20, meanwhile Nvidia is growing 70% for the revenue year over year and for the profits even higher. The margins are ridiculous for this company. This is the dirt cheap. For Microsoft, I would say that Microsoft is close to the buying range, but Microsoft is still a little bit expensive at 26 times next year earnings. Amazon is very cheap at 27 times, and we will see on the technical segment of the show where is the buying zone of every of this stock. Now, the main mistake investors do when they face this kind of market downturn is that they panic, they don't know what they own, and they are panic selling because the price is just going down. And this is the big mistake. If you know what you own, you will not be scared during this kind of market downturns. For me, for example, my biggest position in my portfolio is Amazon. Amazon is taking more than 25% of my portfolio. I know exactly why I invested in Amazon. I have my projection, I have my DCF model. I know exactly where Amazon will be in 5 years. So if now, because of some tariffs from Trump, because of some Atlanta GDP, because of some seasonality, they want to sell me Amazon under $200 per share, I am a happy buyer. So the conclusion is that do not panic. You need to know what you own. You need to have your research. If you do not know what you own, you need to start researching the companies in your portfolio right now. And also, the most importantly, you need to build the watch list of the company you want to buy. So when the price reaches the price target, which you believe is the fair for this company, then you are ready to pull the trigger. Now, why is this the buying opportunity? Let me explain. The company stock is going down for two particular reasons. Two and only two, nothing else. The first reason is a company specific issue. For example, we can see that Google is trading at 17 times earnings because the Wall Street thinks that he's losing the market share, because the Wall Street is worried that 50% of Google's revenue is coming from search. Another reason why the company stock could go down is the macroeconomic uncertainties like tariffs, like GDP decline, like seasonality and stuff like this. This is macro related stuff, has nothing to do with the business of the company. And for us as a long-term investors, this is the generational buying opportunity. And we can absolutely buy the dip in these companies. For you, of course, you do your own research. But for me, I'm telling you that I just bought these stocks yesterday in a technical segment of the show. I will tell you exactly which stocks I bought. If you calculate the intrinsic value of your companies, if you know what you own, you will understand that this is the definitely buying opportunities. Now, this strategy will work only for high quality stocks, because for some bad companies, you probably could be catching the falling knives, but for good companies, they will definitely bottom and they will go higher, and finally they will beat all-time high because their revenue growing, cash flow, profitability and stuff like this. Now let me explain how to differentiate the good companies from bad companies. Now the criteria number one: strong economic moat. If the company has a strong moat, it can protect it from the competitors. I would say the companies monopolies like Amazon, Google, Microsoft, very strong economic moat. The criteria number two: steady growth for the revenue and net income. No matter what's happening in the economy, the revenue is growing, net income is growing. This is a very good sign that management is doing good job reinvesting capital into the business and growing profits. The criteria number three: the strong balance sheet. If you see the company has a lot of cash, not much liabilities, this means that no matter what's happening in the economy, they will be able to survive and they will not have any risk of going under. The criteria number four: high return on invested capital. If the company can invest the capital and get the high return from this investment, this is showing that this company for the long term will be a winner. The criteria number five: high margins. Usually the weak companies, the bad companies, will have low margins because they have no pricing power. They cannot increase the price, because if they increase the price, the consumer will if they increase the price, the consumer will stop consuming their products. But if the product is outstanding, if the competitor could not build the product similar to this one, then the company will have the pricing power. Then the company can increase the price and consumers will continue to buy it because there is no alternatives in the market. The criteria number six: strong and motivated leadership. The leadership is a key for the long-term compounding growth. I prefer to find companies with a founder CEO. I also like to watch different kind of interviews from CFO, from CEO. I will just find, if I'm doing the fundamental analysis for the company, I will just find the video, I will just find the interview, directly go through, try to understand what the direction this leader is going to take this company, and I will see if this direction is matching my expectations. Now coming to the most interesting part of the show, let's see from technical perspective, is there a buying opportunity in big tech stock? Let's go. Now coming to the last segment of the show, we will watch from technical perspective what's happening with these companies and when you can buy it. Starting from Amazon, here you can see on a very long-term monthly candle, you can see the very beautiful 20 years uptrend. And if we see on a shorter term, okay, here we have the overpriced Amazon, and then we start increasing interest rate. The whole market corrected. Amazon also corrected exactly to the bottom of this channel, and in this bottom of this channel it was ridiculous buying opportunity. Okay, what's happening now is we are forming another channel, and if you can see right now we are on the bottom of this channel. I'm not sure that Amazon will go to retest the all-time high here, so in this case the Amazon will go at around the 175. For me, I think Amazon is already a buy here, so I was buying at 200 just yesterday. For me, Amazon is screaming buy here, so it could go a little bit lower. As I mentioned, it could go to 177, 176 to retest this part, but this would be I'm not sure. No guarantee that it's going there. That's why for me this is a buying opportunity. I believe that it will bounce from here and probably either will have some consolidation or going higher. Coming to the next stock, Meta Platforms. For the Meta Platforms, the situation is approximately the same. The problem here is that we have also this 10 years uptrend from 2013 to 2025, but the problem is that now we are trading in the top of this range. So for Meta, from the fundamental perspective, Meta seems very strong. From the leadership perspective, I like founder CEO Zuckerberg seems still very motivated, so definitely believe in Zuck. And also a lot of initiatives they are taking, and a lot of initiatives in AI and robotics. They are starting to go to robotics market. So from this perspective, no problem for the Meta. But from the technical perspective, I would say this is not the time you buy, because this is the top of the range. And what if we go to 300? From 650 to 600 to 300 is like more than 50% down. So for Meta, not sure about that. I am long Meta already, and my average is lower than here. Of course, probably I will start averaging down somewhere between 430 to 370, somewhere in this range, somewhere in the middle of the. Usually when I have this long-term trends, you see there is a line in the middle of the trend, so usually I would start buying here and average down till the end, till the lower part of the trend. It would be usually good DCA. Coming to the Google, for the Google we have similar situation, the trend from 2015, 10 years trend, and right now the Google just yesterday tested at 167, tested the 10-year trends. I bought Google yesterday. I think this is a buying opportunity. You can find the video on my channel about Google. I told that the 165 will be a buying opportunity, and it reached there. You see this candle, it reached there. So I bought Google, I bought Amazon. Coming to the next one, for the Nvidia. For the Nvidia, the situation is not as beautiful as for others. The problem here is that we broke the trend. So you can see here the ChatGPT was announced, the October 2022, the revenue skyrocketed, profits skyrocketed, and we started to go directly to the moon. But now we can officially confirm that this trend is broken, because this is a monthly candle, so it's already 3 months closing outside of the trend, so we can directly destroy this trend. Now where Nvidia is going, I'm not sure. I'm still bullish. I hold my loan. I have a long position in Nvidia. I'm not averaging down here just yet. I believe maybe this 21 months average could be a good point to start DCA at 96, 98. And probably the next station will be 50. Again, I'm not sure Nvidia is going there, but right now the chart is not looking the best. That's what I would say about Nvidia. Coming to the Microsoft right now is a little bit expensive for me. I would prefer to buy Microsoft somewhere between 380 to 340 on the retest of this all-time high. So Microsoft is consolidating. Microsoft is 1 year going nowhere. Other big tech stocks is showing better performance than Microsoft, and Microsoft is having this kind of consolidation. But meanwhile, the business is growing, the free cash flow is growing, operating cash flow growing, net income growing, revenue growing, everything is growing. So everything is good with the business. Meanwhile, the stock is not going down. It means that the multiple of the price to free cash flow and stuff like that, multiples are cooling down, which means that later we will be able to buy Microsoft and it will be better deal. It will be cheaper deal. Coming to Tesla now. For the Tesla, I would say that this is a for the Tesla is not easy to say. For me, I have a long position in Tesla. I know that based on the current business of Tesla, Tesla is very overpriced based on the current car business. But for me, I would like to have exposure to the robotics. And for me, right now, the Tesla is the most obvious play on the robotics market. Right now, we are retouching this point, and now we are touching again. And here we also have a month, 21 months EMA. So I would say from the technical perspective, Tesla is a buy here. Coming to Apple, I am not the biggest fan of Apple. I like Apple from the perspective that Apple has a services business, very high margin, monopoly. I'm also a user of Apple devices. The problem from my side is that Apple is not growing for the revenue for already a few quarters, and I'm not sure the Apple Intelligence will be able to give another push and make Apple a growing company again. So I would not be able to pay 34 time earnings for the company which is not growing. Meanwhile, I can pay 27 time earnings for Amazon, which is growing 30% from the perspective of operating cash flows. And that's all for today. Click like and subscribe to the channel to see more updates like this. And let me know in the comments if you want me to check some of your companies from technical perspective, fundamental perspective. I would be happy to do that. And I will see you in the next video.